Sales promotions are used to stimulate sales at the stores and help them achieve their sales targets. They are effective mainly because they create a sense of urgency and excitement. Whether or not a retailer is applying them depends on their positioning strategy. For example, luxury brands do not have many promotions and discounts. And also on the pricing strategy of the business. For example, retailers who follow everyday low price strategy rarely have sales promotions. Other brands will usually have a defined marketing calendar for the entire year, where it's known which types of sales promotions will be run at which days of the year. There are many types of sales promotions that differ in their mechanics and the level of discount they give. Examples of sales promotions include flat discounts, for example 25% off the full price, bundle offers, for example buy two, get one free, free shipping offers, for example get free shipping when you buy above an X amount, gift with purchase. Here the company specifies a certain gift that could be from the merchandise or a non-merch item to give customers when they buy for a specific amount. Vouchers, giving customers a voucher to redeem back in the store in the future when they buy for a certain amount. Raffle draws. The customer enters a raffle draw for a chance to win a prize. Sales promotions are different from permanent markdowns that are primarily used to clear merchandise. Usually, items that go through a sales promotion get discounted for a temporary period of time and then get back to the original price after the promotion. On the other hand, markdown items usually maintain the discounted price until they are cleared and may even receive further markdowns in the next event. We get deeper into managing markdowns in the merchandising course. Between sales promotions and markdown events, the final sales of the business will have a certain discount rate. That is, the intake margin for the business will be different from the actual realized margin after all the promotions have been done over the year. This discount level will differ from one business to another and even from one category to another, as some categories will be excluded from markdowns. So it's important to determine the discount rate of each category, and then this will be factored in the final price of the product to make sure the final margin will be in line with the target margin for this category and for the business as a whole. For example, if an order is priced to sell at $100,000 at full price, but after applying several markdowns, the actual amount in sales the business got out of this order was $80,000, then the discount rate has been 20%. We explained the difference between intake margin and realized margin and how to calculate both in the retail math course. In the next lesson, we will explain how to determine the ROI for a certain sales promotion. Some companies require you to submit a promotion ROI calculation when you propose to make a certain sales promotion during the year. This is to make sure that the sales promotion is actually benefiting the business and not just reducing its margins. This is mostly the case if this sales promotion was not part of the marketing calendar. Otherwise, it's already factored in the original sales and margin budget. You might have been facing a slowdown in sales, and so you want to propose a certain sales promotion to activate sales. If an ROI is requested from you as part of the proposal, here is how to calculate it. You can calculate this ROI by calculating how much uplift in sales this promotion will generate and how this will translate into higher profits despite lower margins. For example, during the 3 trading days at full price, the expected sales are $100,000 at 60% margin. This means a 60% gross profit for those days in case of not running the promotion. The proposed promotion will double the sales to $200,000 but at a margin of 40%. This means the gross profit for those days will become $80,000. This is an increase of $20,000 in gross profit coming from the promotion. If the uplift is high enough, the lower margins can still generate more gross profit in absolute value, as demonstrated here. So the return for the business will be $20,000. If you will have to spend on marketing or advertising the event itself, for example, through an SMS campaign or social media ads, let's say $500, you will deduct the marketing spend from the $20,000 and the result will be the return. So you will justify running this promo by saying that if we do it, we will add $19,500 in gross profit. In the next lesson, we will explore the downside of sales promotions. As we've seen, sales promotions could be a very powerful tool to stimulate sales and create an excitement around the brand and drive more traffic to the stores. However, sales promotions can be very dangerous for a retail business if not used wisely. This is not only because they reduced margin during the promotion, but because they have the ability to reduce the margins for the entire business going forward. When consumers see that the business is having repeated promotions on the items they buy regularly, they start setting a reference price for those items, and this would be the discounted price. They then start to refuse buying it at full price because they now feel that the full price is actually high. Besides that, the business will soon have a promotion anyways, so they might as well wait for it and buy at lower prices. So the business gradually finds itself having to keep running those promotions repeatedly because now they start being the main driver of sales. This also begs the question of whether the uplift in sale is now happening because of the promotion or because people are shifting their buying to avail the promotion instead of buying at a later time at full price. In other words, you will start having some customers who might have bought the product anyways at full price start waiting for the promo because now they know that you have a promo every month and they then make their purchases at that time. That's why sales promotions should be carefully planned in advance at the time of the annual budgeting, and retailers should stick to the plan they have made, unless something happens and they really need to launch a sales promo to drive sales or clear inventory. The other benefit of planning in advance and sticking to the plan is to be able to determine the right discount level, as we mentioned earlier, so you can factor it in the initial price of the products. At some point in their life cycle, businesses are faced with a situation where they have to increase their prices. This could be due to inflation, where the cost of labor in production and transportation have increased, and the business has no other options but to pass those increases to the final customer. Another reason could be that the business has originally made a pricing mistake and is now not being able to make profits at current price levels. Or it could be that the main suppliers have increased their prices and now the business needs to pass those increases. Let's say that the business has determined that it needs to increase its prices by 10%. Instead of applying a blanket 10% increase in all prices of all products, a better approach that's in line with our pricing approach is to go through the portfolio one by one and take all the other dynamics into consideration, such as supply and demand for each product and the competitiveness and its positioning, and then increase each product by the appropriate degree, while at the same time making sure the entire portfolio has been increased by 10%. For example, we could increase a competitive product by 3% only, but that's okay because our differentiated products, we are able to increase them by 12%. This brings us to the end of this course on retail pricing and promotions. Thank you very much and see you next time.